This is NTV.
Welcome to this edition of Business Redefined. The half-year season is still here with us, and we are privileged to have Moses Mudoe from ABSA, Chief Strategy Officer as well as Finance Director in charge of the Corporate Investment Banking Unit. Welcome on set.
Thank you very much. Thank you.
Looking at your numbers, I'm really intrigued by your asset quality. Your NPL ratio is in the single digits comfortably, and also when I look at the quantum number, you're clearly placing a very tight lead on the bad debt. It almost looks to me like you're in a very different market from other players.
I think in banking, you always have to read the cycles and potentially read the cycles early enough before they occur. There's always, first in, last out as you manage through the cycles in terms of portfolio quality. So I think even before COVID, we sensed some stress in certain areas. We began to tighten a bit on the hospitality side. We exited most of the airlines assets that we had many years, just before COVID. And on the retail lending side, we began to shift slightly from private schemes to which are probably payday-based lending to more government schemes that are more certain. And then we began to shift our book more to the secured side. With ramping up our mortgages business. But even then we started to open up for SMEs because we were really underweight in the business banking space, and we began to really open up unsecured on that side. So when we started to navigate through COVID, there was already some form of cautiousness in how we were building our balance sheet. Right? Remember, we grew our assets by 20% in 2018, 15% in 2019. So it wasn't really curtailing growth. It was just kind of thinking about where are the right pockets of growth. I think with COVID, very quickly, we realized some of those calls were the right calls we made. And then we began to look at those accelerated pockets of severe stress that would come a few quarters down the road. We tightened further on hospitality. And so if you look at our wholesale balance sheet as an example, there isn't a single sector where we are above 7%. So it's fairly well distributed. So that really has helped us. On the retail side, again, we began to focus more on profitability. So, this explosion of mobile lending, we kind of shifted back from volumes to value. Yeah. And our Timiza is now profitable 14 months in a row, even during the COVID period. So we didn't just open up volume growth without worrying about quality. I think the last thing is that we were very decisive with about 60 billion of restructures that we did. We've seen the regulatory forbearance come to an end, first quarter of this year, and out of that 60 billion, only about 3.5 billion has not been fully cured. So those have become NPLs. We've fully provided for them because they're stage 3 impairments. So you're seeing from 60 billion to 3.8 billion, fully curing almost 90% plus of that book. So net, I'd say, designing the economic cycles, being fairly balanced in our portfolio, but also ensuring that we continue lending. And if you remember last year, we lent 103 billion to the economy gross basis. This year, half year, we are running over half of that amount. So we're not stopping lending, we're just being cautious on where we lend and what we focus on.
Just give us a sense in terms of when you look at the book itself, how would you say it is categorized in terms of large business, small business, medium-sized business? And why I ask that question is because there's often a perception that the MSME segment is a main driver of NPLs, but sometimes you go to an earnings release and you're shocked by it.
Yeah, so diversification is very important. I mean, no less than in banking when you're going through periods of uncertainty. If there's something we learned from the global financial crisis and indeed the last 18 months of COVID crisis, is that a retail wholesale 50-50 diversification is going to put you in a good state. Retail banks always outperform when there's an up cycle. Wholesale banks always outperform when there's a down cycle. Net 50-50 gives you a more predictable financial profile. Our balance sheet sits, when you think about wholesale, which is large businesses, small businesses, medium businesses, and the retail, which is the consumer base, is fairly well balanced. You've seen our earnings today. The wholesale bank contributes 59% of profits in the first half, and the retail bank about 41%, which shows you the power of having that 50-50 diversification. Indeed, when you look at our NPLs, even though our NPLs absolute terms have gone up 7%, in terms of split between wholesale retail is 50-50. So again, from an NPL point of view, we are fairly balanced. I think strategically, running a bank that has got that diversification provides that cushion no matter the economic cycle. I think the question becomes within the pockets of wholesale, where do you accelerate? Where don't you accelerate? We are absolutely focused on growing our business banking small businesses segment. Our wallet share is not where it needs to be. Our corporate business is quite sizable. There are pockets of growth, but there are risks there. On the retail side, always focused on smart growth, driving unsecured for profits, not for volumes. So you're going to see us run a 50-50 strategy through the coming quarters and the coming years, I think.
I thought the loan loss provision was significantly slashed, especially considering the 7% uptick you've just mentioned.
So last year, we took 9 billion of credit provisions, impairments. About 4.6 billion of that was portfolio quality. You impair loans that need to be impaired. About 1.8 was single names on the large corporate side. And 2.6 was overlays we took deliberately to position for what we thought was going to be quite a subdued macro environment. We didn't have to take the 2.6 billion because these were overlays on performing book, not the non-performing book. So as we've seen the macros and run our models in the first quarter and the second quarter, what we had assumed, whether it's unemployment or currency or inflation or GDP, we had taken a very conservative view. The outcomes are quite different. We've released about 1.5 billion of the 2.6 this side of the year. That has left us with about 1.1 billion to release looking forward based on where the macros go. So there's that impact. I think the second impact is portfolio quality is absolutely, in terms of new vintages, absolutely within our expectations. The leads we put last year, the conservativeness has helped year on year on an underlying basis to show reduced impairment. So on a loan loss ratio basis, we're at 1.8%. That's perhaps where we were in 2019 pre-pandemic. And I think that's the levels perhaps we need to run at. So it's sustainable when you think about it in those terms.
Speaking about your appetite for the mortgage business, why that is of interest to me is because the real estate sector has been hit. Even prior to COVID, we're witnessing a bit of a lethargy and sluggishness in it. How then do you ensure that your risk profile on that side is well calibrated?
Yeah, so I think there are pockets of the mortgage market, the residential mortgage market, that are sweet spots. You've got to study, the mortgage market indices across different stratums, right? Not the entire collective. We're clearly not big in commercial property finance or commercial mortgages or lending for commercial real estate, and I think that has been severely hit. If you look at the numbers, so we're not carrying any excesses on that side. On the residential side, first we've got to look at our customer base and ask ourselves, those who've serviced different asset classes on time, on budget, across the cycle, and probably have solid businesses or continue to be employed. And you look at our book where it sits today on mortgage, and you think about market leaders on the residential mortgage side, there's clearly a gap for us to go. So the book is not where it needs to be. We're building it. We are cautious on how we diversify our risk and the pockets we pick. I think the middle market. There are challenges in there. I mean, you've seen the rolling in house prices and the rentals coming out of that, and therefore serviceability of debt from whoever's borrowed to kind of take those assets in the middle market. Low market, huge opportunity. Top end, some opportunity. Just fairly balanced as we read the cycle in the residential mortgage market. Yeah.
Government securities and interest income from that side, I noticed a 7% dip. What's happening about that? Is it about the softening of the yield curve, or what's playing out there?
Yeah, I think strategically we have to always be cautious to to meet the social contract of banking, as sometimes I'd like to call it, which is you've got to lend to the consumer. I mean, that's the only way the economy is going to recover. So we always have to balance, where do we shift the power of our balance sheet, right? I mean, it's good to get the yields and ramp up your available for sale portfolio, almost run your margin risk-free, report higher income. What about the consumer side? I think, what about small businesses? So there's a deliberate effort to balance between, for the funds we have that we've been entrusted with, how do we balance them between consumer lending and lending to the government? That's number one. I think secondly, there are sovereign risk limits. We are part of a group. The group has views around sovereign risk across the continent. They're quite positive about Kenya from a sovereign risk point of view. So we always often look at those limits and ask ourselves, where do we want to run in terms of our sovereign risk limits? I think going forward is going to be a fair balance between how you oscillate from your deposits to either customer assets or they're available for sale. Which one tapers off at what point, given the yield environment. We're quite deliberate. I think we're likely to see some probably uptick on the available for sale. But over the cycle, and as we think about the medium term, absolutely growing our customer asset base and lending to the consumer and to businesses is going to be of more importance.
Let's talk a little bit about your non-funded income. First is that I noticed the income from foreign exchange trading just flatlined. Why is that?
Well, so I think if you think about last year, what we report under that number, there's incredible volatility in the currency market last year, particularly
in the Q3 side.
Yeah, absolutely, right. And our markets business is volatility dependent, right? So when volatility is heightened, you'll see some one-off big revenue items come through. I think that's been subdued this side of the year, the first half of this year. Very comfortable with the price stability we are seeing. Not much volatility, not major tectonic news like COVID is here, and therefore currency fluctuations that we saw. So there's obviously the environment is a bit more stable, and that's one. Secondly, I think is just trading volumes, right? Every time trade volumes either stabilize or reduce, clearly the fee out of those volumes from an FX point of view is also subdued. So the trade volumes are probably steady and stable from rapid increase Q1 last year. The real impact of trade volumes was in Q3, not even in Q2. This year we've had 2 quarters of just steady, not significant trade volumes, and that's what's happening there. Again, it's a cyclical business. Our markets business, which is currencies, derivatives, brokerage, has been a market leader for a long period. We just have to manage it through the cycles. Yeah.
And still on the NFI, I think one of the sweet spots in these earnings was just looking at it as a share of the entire revenue pie, and now sitting at about 33%. My question is, what's your target, and how far do you think you can push this envelope in terms of that diversification?
I think first of all is just to recognize the nuance between this year and last year. With items like fees from digital transactions that were there in the first quarter that are not there this year. And even within that environment, we've seen our NFI go up 6%, despite the regulatory forbearance persisting in terms of fees you can charge for digital transactions. We've really been on a deliberate effort to diversify our NFI sources. We have a very solid bank assurance business. We tend to see clients underwrite risk when there's a down cycle, so insurance businesses tend to do well. We've seen clearly significant growth in our insurance business. We have a brokerage business that didn't exist 2.5-3 years ago. That brokerage business is substantive now. We launched our asset management business this part of the year. And I think with Timiza, the fees we get there, all these things have supported NFI to grow despite some challenges of some revenues entirely disappearing. I think that 3% is a good level. Probably as we build and diversify for the future, we see this philosophy of smart growth. being growth that is less dependent on capital-intensive pockets of our balance sheet. I think regulation in terms of capital and risk-weighted assets and the advancement of Basel, all these things are going to make capital such a very, very scarce resource, and where you apply it and the return you get from it and the risk you run on it, all these things will be important. So we will continue to push the envelope on the NFI side. 33 sounds like a good space to be for the first half. We hope we can improve on that going forward.
Right, at that point, by Moses Mudhui takes us to a short break. We shall be right back with this conversation now, focusing more broadly on the banking sector. Stay tuned.
Enjoy the best family entertainment on StarTimes Classic or Smart Bouquet.
Oh, yes.
Subscribe to Classic Bouquet for only $899 for 30 days or Smart Bouquet for only $999 for 30 days. Come on eBay. Ni StarTimes.
I'm growing into every moment.
Nurture the moment. Minute Maid Nutri Defenses, fortified with vitamin E and zinc to help improve your defense system.
Geisha coconut milk and honey, enriched with coconut milk for soft and moisturized skin.
Be strong and last long.
Babe, I'm at KFC. Do you want anything?
I'm actually not that hungry, babe.
I'm actually not that hungry, babe.
Coming right up.
Are you sure?
I just ate.
Add an extra, I just ate.
Got it.
But
I'm fine. Don't get me anything.
Try the new KFC Duo Bucket. 4 delicious pieces of KFC chicken, 4 zinger wings and chips. The perfect sharing meal for 2.
See you now, babe.
Wow, thank you for your time.
And do you have any question for us?
How juicy.
Juicy. Juicy. Nico fiti maze Nico fiti. Majamana mabenti wako fiti. Juicy fruit.
Today tastes like a piece of the action. And it never tasted this good.
Lucozade. Energy to get through it.
Welcome back to this conversation on Business Redefined. We are privileged to have Moses Mudhui from ABSA. Welcome back on set.
Thank you.
Your cost-to-income ratio, I mean, your rationalization is clearly evident in your numbers. And looking at where it's sitting now, I think it's in the mid-40s. Just how further do you want to push this again?
Again, thanks. We're pleased about the efforts we've put around efficiency. That number used to be mid-50s, close to 60s. We navigated through the rebranding period with one-off expenses that pushed it to the 50s. We were very keen to make sure that when we come off the rebranding, we'll see a convergence between the published number and what we used to call the normalized number to that below 50. We're very pleased to be at 45%. I think it's a function of a number of things. One, revenue is growing. Secondly, we've dealt excess capacity that the business has had from 2013 to date. Thirdly, one-off expenses are behind us. So that mid-40s is sustainable. What that tells you is, just to answer your question about, as we think about the future, if revenue is going to continue growing, which is our plan, and the cost-to-income ratio sustained at mid-40s, the absolute cost will have to slightly perhaps go up. So the plan is to reinvest that additional cost into revenue-growing initiatives to keep the level of mid-40s cost-to-income ratio. We think mid-40s is, again, a good space to be. And if our revenue continues to grow, as opposed to driving it to below 40s, where, again, you begin to question whether, your operating leverage is well managed at very low cost-to-income ratios. I think reinvesting and making sure we stay at mid-40s while revenue grows up is perhaps strategically the rails we want to run.
I looked at your cash flow position and the liquidity that you're sitting on, and I thought, did a dividend have to wait for the full year, really, when you have shareholders who are anticipating something, given the kind of results you've put out?
Yeah, I think it's a very good question. We always seek to assess the ability to pay dividend based on whether our capital position can afford it or not. And the first half, we have 13 billion of capital buffer. So fairly a very good question to ask. I think we have to weather the quarter three and see in quarter three and quarter four, what outcomes come our way. I think if the outcomes remain within expectations, we'll reassess resumption of dividends at the full year. But we are comfortable on capital. We just have to be cautious that we're still very much within this pandemic. No one knows what's going to happen with the fourth wave or where vaccination rates will go, whether we'll end up with more severe or less severe lockdowns, and what that would mean in terms of extending, forbearance to our customers again. So these are known unknowns. And I think as you're managing through the financial calendar and the financial year, perhaps you're most certain at the end of the financial year to make a call. So we just have to wait for quarter three and quarter four and see what call we make at the end of the year. Let's now talk a lot more regarding the banking sector. First question is whether you have received any guidance from the market regulator regarding the issue of pricing. It's been an ongoing conversation. Any update from your side? Yeah, so I think the conversation is ongoing, very much collaborating with our regulator. I think, we have nothing to report at this point in time, but hopefully, we get to provide an update once we get to a very, farmed up guidance on the way forward. I think we are very much pleased with the conversations and the openness and the support we are getting from the regulator. And I think it's an industry conversation. And we just have to wait and see where this goes. We are very optimistic. I think everyone wants to really see credit growth in the private sector. We've seen 7.7% growth in the first part of this year. We think that number will go up. Banks have to be there for the private sector. We have to continue extending the power of our balance sheet to lend to the real economy. And everyone is very much within that same spirit. Okay. Allow me to push that conversation a bit because in view of the risk profile out there, there's a lot of concern in terms of what this protracted period in terms of the negotiations is having in terms of impact on banks. Are you extremely bothered by that? Not bothered at all? Do you think we can still carry on like this? I think we're still growing. As I said, we grew our assets 2018, 20%, 2019, 15%. If you compare this year and 2019 pre-pandemic, we're still growing. And that growth can only happen if you're lending. So we're still lending. From 103 billion last year, gross lending to the market. As I said, this first half of the year, we've lent more than half of that. I think there's still pockets to continue lending and to continue doing so profitably. So I don't think there is necessarily a handbrake. Of course, one has to evaluate whether you can accelerate much faster, but I don't think there's a handbrake to our growth and how we lend to the economy because of the conversations that are ongoing. In the recent past, we've seen a lot of M&A activity with the big players in this market going to markets such as DR, Rwanda, Tanzania as well. Is ABSA lining up something of the sort in the pipeline, or what's your near-term outlook looking like? I think M&A really just makes sense in terms of what is your strategy, right? Consolidation in market, existing market, or expansion to new markets. Certainly, we're very comfortable with the runway we have to grow our business organically within the Kenyan market. And I think regionally with our group, we have significant presence. We're part of a solid, sizable, scalable bank with 12 trillion shillings of assets across the continent. We have 2 banks in Tanzania, 1 bank in Uganda. We have the Kenya Bank. The Kenya Bank is 400 billion in assets. The East Africa combined operations, quite significant asset base. So from a group point of view, because we have to operate within the group context, we're in the markets we need to be. I think we've got to think about our strategy within the group from, what must we buy, but what can we build or where can we partner? So building capabilities and partnering for capabilities perhaps for us makes more economic sense than buying a capability within the Kenyan market, just more specifically.
Let's talk about the asset management venture. And I remember sitting down with Jeremy early this year, and my question was, don't you think the timing could be inauspicious? Because, I mean, look at how the market is. And looking back, how is it performing? What's your assessment?
Yeah, so I think it's early days. This is the second quarter, having launched our asset management business. I think there are two sizable opportunities that we see when we look at the market. There's the institutional side, which is fund management for pension monies, endowment funds, foundation funds. Clearly a huge pool of funds, 1.4 trillion out there being managed by fund managers. So we see ourselves having, hired very solid fund managers to join us penetrating that space. I think the other side is value add on the retail side, where you begin to introduce investment products to the more sophisticated retail customers, or more simpler unit trusts to your less sophisticated retail customers, doing onshore and offshore. So there's a value add to clients. I mean, clients want it, they need it. It earns us a return, so it's the right thing to do. On the institutional side, we'll penetrate it as we go. But the plan is to continue driving those two sides of our asset management business. Very early days to share any numbers, but we'll be looking forward to discussing more outcomes in the coming quarters. Yeah.
Right, and that point by Moses Mudhui takes us to the close of our conversation, where we have been focusing in part one on the results which have just been released by the bank, and in part two touching onto issues regarding the banking sector. Stay tuned to Business Redefined for more coverage on these issues.